My name is Carey Sobel, and I am excited to introduce you to the second part of our series called Boss Talk. Our first 25 episodes featured a ton of content about selling businesses. The next 25 will also be about selling businesses, but we have a new format. We have some new guests that are going to participate in the content that we provide to you, and we are super excited to talk about today's episode, which is called The Tax Implications of Selling Your Business. And with that, I'll introduce my partner, Jim Parker.
Well, thank you, Carey. I appreciate you doing such a great introduction. I'm really excited about this episode because a lot of times business owners are like, how much is my business worth? How much is my business worth? But at the end of the day, it's not how much you sell your business for. It's how much you get to keep in your pocket. And I think that's what we're going to be talking about today with taxes.
That's right. And
you might not get an exact figure, but you get an idea of what your tax situation's, how it's going to be set up.
That's right. And for that reason, we have brought on Richard Hayes from Coastal Investment Company to join us today. I'm going to have Rich introduce himself, but first, a little tidbit about Coastal. We are a private investment firm in Winter Park, Florida. We help provide institutional real estate and venture capital investment opportunities to our clients. We really focus on two things. One, investment opportunities, and two, tax mitigation strategies. Perfect segue into Rich. Rich, tell us a little bit about yourself.
Thank you, Carey. It's nice to join your podcast. Thanks for having me. I actually watch your episodes myself, and I learn a lot from you guys. Just a quick introduction about me. I'm a career CPA. I've bounced around Winter Park and Orlando since the late 80s when I graduated from UCF. I spent a decade with a big CPA firm, 25 years running my own boutique firm with a partner. And then about 8 years ago, I decided I'd had enough of the grind. And as I got more into consultative work, I evolved out of the CPA business. And now I work full-time here with Coastal.
Awesome. And Rich heads up a good portion of our tax consulting and strategic consulting for our clients. A lot of our high net worth clients have liquidity events, or they're just high owners. And of course, reducing the amount of taxable income that they pay is always a challenge and something that we enjoy solving for our clients. The synergies between Boss and Coastal are pretty easy. Jim, we sell businesses, and when we sell a business, people usually ask us two questions. What do I do with this money? Mm-hmm. And how do I save on tax? And then, Coastal's clients, a lot of them are business owners that eventually want to sell their business. So we kind of play in that little space in between.
And Carey, real quick, if you don't mind, I just want to kind of, so the audience is aware. So Boss Group International, it's myself and Carey, and then we have a third partner, Tony Blair, and then we have 5 or 6 agents and some support staff. And then Carey, you're a partner in Coastal as well.
That's right.
And Tony and I are not. I'm just trying to give the audience
Makes sense.
A mind frame of how Coastal's made up.
And since we're brokers and we're not accountants and we're not tax strategists, we don't give that advice. In fact, my disclaimer here is to consult with your tax professional, and this conversation is meant to paint with broad strokes. But,
I second that, Carey.
Well, Jim, you hit the nail on the head. It's not about what you make, it's about what you keep, right?
Yep.
And it's never too early to begin strategic tax planning, whether you're going to sell your business now, a year down the road, or 5 years down the road. Understanding the basics and the fundamentals on how a sale of a business actually results into what you take home. Taxes is the biggest topic. So tax planning for business sales matter. And sellers, they're typically focused on their top line price, but what matters is after tax proceeds. So I would call most CPAs general practitioners, right? They file your tax return. They may come up with a couple things to reduce your taxable income, but they are not necessarily focused on business sales and how to properly structure a business sale for the best tax benefit when you sell. So let's talk about probably the most important point, Rich, the allocation of a purchase price.
Well, I couldn't agree more, Carey. And it's a very basic item. It's blocking and tackling in the agreement. And it's something that you can't fix after the fact. So it's really important as you're negotiating your deal, creating an agreement, the buyer and seller are working together to craft that document, craft those values. And I think it's a bit of an unwritten rule. I don't know if you'll agree with this or not, but the buyer usually dictates asset sale or stock sale, right? They're coming in buying the business. They dictate the basic nature. The next item that's negotiated is the purchase price allocation. And the seller usually gets a little bit more of the benefit of the doubt there and gets to sort of come to the table and create some values there and hopefully get a good outcome. If we dig deeper, why is that important? That is the document that creates the method of taxation of the proceeds from the business. So that's going to determine how much of the proceeds are taxed as ordinary income and how much of it is capital gain. So we love to start with how much of these proceeds can we basically cut the tax rate in half, right?
That's right.
20% roughly versus 37%.
And we'll dive into the two different tranches of long-term capital gains and ordinary income, but it's Form 8594. And I have written down here, the IRS doesn't strictly require both forms to match on buy side and sell side, but it does trigger an audit risk if they don't match. And essentially, as a part of your closing and the closing documents that govern the transaction, the bill of sale, the indemnification forms, is this allocation form. And when you sell the business, there are different classes of assets inside of the business where you can put tranches of a dollar amount towards. So let's say the sale's $5 million, right? In that $5 million purchase price, how much is going towards furniture, fixture, and equipment? How much is going towards inventory? How much is going towards accounts receivable? How much is going towards real estate, intangibles, and goodwill? And these different asset classes are taxed at different rates. So let's talk about the two different classes of...
and kind of go explain it one step further. That was
Please.
a good explanation. But at the next time you file, after you sell your business, the next time you file your tax return, you're going to have to report to the IRS that you sold your business, and you're going to have to break down how that sale took place. So like in the example that Carey gave, it would be, sales price was $5 million, for example. Let's say that the furniture, fixtures, and equipment was $750,000. The inventory was $250,000. Let's attribute $50,000 to a non-compete, which gets taxed at the same rate as goodwill, I believe. And then let's just say the rest was goodwill. And so you got to break down to the IRS how that took place. And then the buyer, the following year, tax year, is going to have to report that they bought the business, and they're going to have to put the price, and they're going to have to do the allocation on that as well. And Carey's correct. I think most of us brokers just say, hey, those have to match up absolutely 100% of the time. They don't, but they should. I would say, they should match up.
If you can mitigate,
because it could open up an audit. It could open up an audit.
You're going to want to do that 10 out of 10 times.
Because you're going to have to cross-reference each other when you report on your tax returns too. So I'm sorry to interrupt. I just wanted to,
Well, and I think I'll piggyback on that and just say when the forms match, there's a de facto assumption by the IRS, and that's always a dangerous thing to say, right? But they're going to assume that an arm's length transaction, this document is accurate. So our first order of business is to try to get the buyer and the seller to agree, because then if the document or the transaction is questioned, the IRS's baseline position is two people on opposite sides of the table agreed that these are the right values. We're going to assume they're right. So we have a 100% defensible position in that scenario.
Phil, that's fantastic. Can you touch on a little bit about why, what's the benefit of the buyer and what's the benefit of the seller in the allocation, and that those two are at odds with each other on that allocation? Can you touch on that a little bit?
Sure, they truly are, because the buyer comes in and they want tax relief for the money that they just spent for the business, right? They want to be able to deduct as many things as they can as they're taking over this business or building it or whatever their strategic plan is. So they want to categorize things that for them are deductible faster, but for the seller, it's going to be a higher tax rate, generally speaking. So the buyer wins, they get faster deductions, but the seller pays more tax. The seller wins, the buyer gets less deductions, and the seller gets a lower tax rate. So that negotiation is sensitive, it's important, and there's things we can do behind the scenes to bolster an argument there.
And I don't want to go to the allocation too far. You might kill me for this because I'm going to give more an exact thing, but so the more money that's attributed to furniture, fixtures, and equipment out of that allocation, the buyer is going to be able to write off quicker, usually 5 years. Is it safe for me to say 5 years of write off for the buyer? So they're able to depreciate that, over 5 years. Whereas if it's goodwill, we're looking at 15-year amortization. So it's a lot slower time period to collect, to depreciate the money.
What I always tell the clients is the easiest way to think of this is buyers want to buy assets. They want to buy FF&E. Sellers want to sell goodwill.
Yep.
And it's because of their tax rates. So Rich, can you tell us the tax rates for
ordinary income and capital gains?
Sure. So let's talk about the highest rates. They're graduated, but the highest rate for ordinary income is 37%. And I think we're assuming most business sales, the owners that are selling are pretty involved in the business. So we're going to forget about net investment income tax and some other small surtaxes. And we're going to say that the highest capital gain rate is 20. So it's a sizable difference.
Oh yeah.
The purchase price allocation statutorily is actually six different classes of assets. But so you're required to move down the list. This is a little boring, but you're required to move down the list from the most liquid to the least liquid and then into the intangibles. But maybe I'm getting a little ahead of us, but you can build a case for goodwill. So even though you start top to bottom statutorily, you build a case for goodwill. It helps you with your negotiation and it helps substantiate the value that's most beneficial to the seller.
Really important point and question, and I'm very curious, Jim, what you do here. Since the allocation of the assets is such a critical component to the tax implications for both buyer and seller, do you typically have your buyer and seller negotiate this before they get their closing documents? And the closing documents are typically distributed pretty close to closing.
Absolutely. 100% of the time we do the allocation. In my practice, we do the allocation before closing. So it's always done before closing because my concern is I don't want them to be arguing or debating this post-closing or one party, usually the seller, out traveling the world. Tax season comes up, the buyer's trying to get a hold of them. But sometimes, Carey, when we're dealing with a lot of furniture, fixtures, and equipment, sometimes we negotiate that up front at the time of the LOI or the asset purchase agreement.
That's what I was going to ask. I did a transaction recently where in the LOI, even before we got into an asset purchase agreement, we negotiated the asset allocation. The seller was so concerned about where they were going to end up. They just needed a number that they needed to walk with. So, well, you should probably get a tax projection from your CPA. And you should probably talk to a CPA that specializes in selling businesses to do that, which she did. And we actually had as a part of the LOI, the allocation, which to this point, because we haven't closed yet, has not been renegotiated. So,
and you got to work in the realm of reasonability. You know what I mean? You have to work in the realm of reasonability. I mean, if you got equipment that your equipment's worth $500,000 and you're the seller, you can't say it's only worth 50 grand unless there's some way you can prove it. I mean, it's got to be in the realm of reasonability what you're doing.
Rich,
but you got the low end of values on equipment, you got the high end. So as a seller, you want to be on the lower end. The buyer wants to be on the higher end.
Well, in our listing agreements, sometimes we'll put a value on what the seller thinks their FF&E is worth. Rich, the question I have to you on this is, since that number is fairly arbitrary when we're doing a listing agreement, isn't there a way to cross-reference the tax return and find out the depreciated value of the equipment that's been claimed?
You certainly can. You can get net book value that way. That's not necessarily market value. And if it's a scenario where there's a lot of equipment, a lot of valuable equipment, you can resort to a valuation if there's a big difference between the buyer and the seller's position on these kinds of things. And I've worked on a couple of transactions where unusual situations, for example, an oral surgeon, dentist, and he had an incredible amount of goodwill because of his skill set and the particular suite of services he offered. So where we started and where we finished was different because he had lots of equipment, but actually the bulk of the value was in him and his reputation of the practice and the quality of work. So if there's a big difference, you can use an appraisal, you can use net book value, and you can also bolster your case for goodwill.
I had a note here that there is a mix that ultimately depends on your tax rate. That's not just the allocation of assets towards, what will be taxed at ordinary income versus long-term capital gains, but also the entity type. A sole proprietorship versus a partnership versus an S Corp or a C Corp. Any feedback on that?
Yep, that's definitely true. And they're kind of night and day different. What most business people are using these days is what we call flow-through entities. So a sole proprietor or disregarded entity, a partnership, or an S Corp. And those, all of those scenarios create a tax burden on the individual tax return. And one of the benefits it offers is we can take a holistic approach to the tax planning. After we deal with the business sale, we can look at the personal tax return and what else can we do to get the best outcome tax-wise. When you're dealing with a C corporation, there's tax within the entity. So you have to plan for the tax that the entity pays, and then you have to get the money out of that entity as tax efficiently as possible. I think if we go too deep on that, it could get confusing, but you're right. It's important from the start to note that, and as much as you can before the transaction, plan for it.
And I don't want to go down this rabbit hole, but I know that there are, in the last 25 years, if you incorporated or you became a certain entity in a certain year, You get a certain tax advantage when you sell. I mean, there's just weird laws out there too that I think are so weird that I don't think we need to talk about them here. But
well, let me date myself. And one of the things you're talking about is general utilities doctrine, which was later repealed, but it took one of the layers of tax away. So
Fair.
It's not available anymore.
no,
We'll talk about one of the basic parts, Jim and Rich. We'll talk about asset sale versus stock sale. So, Jim, I think 95% of the transactions we do are asset sales.
Yep.
Correct? But there are stock
But
sales.
I would say real quick, 30 seconds, why? You want to explain real quick why they tend
Sure.
to be
So
asset sales?
an asset sale is essentially when you're buying the assets of a company, you're going to spin up your own entity, and you are not going to purchase that existing entity, but you're going to transfer the goodwill and all of the assets over to the new entity.
You're just buying the assets and goodwill.
Versus a stock sale where you are actually buying the stock of the existing company. There's advantages and disadvantages, but probably the biggest reason why we always encourage an asset sale is because when you're buying the stock sale of a business, you're also buying all of the liabilities that come along with
known and unknown.
Known and unknown liabilities that come along with an existing company. There are reasons to do a stock sale in Main Street and lower middle market transactions. We discussed that in one of our previous episodes, so we won't dive too deep into it. But from a tax implication standpoint, Rich, what are some of the reasons why or implications of related to tax for asset versus a stock sale?
Sure. So I've got another good example with a client that we had for years, and they operated medical locations in extremely difficult circumstances, like countries that had conflicts going on, and they had specialty government contracts, and you can't transfer the contracts easily, but you can disclose and sell the stock of the company. So that was one that absolutely had to be a stock sale.
And that's usually the number one reason why we see stock sales, right?
Yeah.
Is that you were trying to get those contracts over to the buyer.
It's a contract.
Yeah.
It's some kind of licensing designation. It's something like that.
Because usually any of those designations or licenses or whatever are granted to the existing entity. So if you're not actually changing the entity, a lot of times you don't need to make the regulators aware of it. There are some
You just buy the corporation. You're
you buy the
inheriting
corporation.
everything that corporation owns.
That's right.
So you don't have to transfer anything.
And now sellers would probably prefer to do a stock sale.
No doubt.
Yeah.
Because then all your gain is capital.
Capital gains. And long-term capital gains are taxed at a lower tax rate. So buyers prefer asset sales because they get a new basis and they can depreciate and amortize what they buy. So let's talk about that. A buyer buys a new business. Let's say they use financing or not, and they acquire assets. Let's talk about the FF&E. In the case that a buyer is buying a business where the assets have been fully depreciated, do they still get any value in purchasing a business?
Absolutely. You get, I guess a step up in basis is a good way to put it, right?
Yeah.
We're basically using that asset purchase allocation document, and we're capitalizing the assets that have been purchased. And then not only can you depreciate them, but we now have bonus provisions in place for depreciation. So it means that for all the FF&E and really all of the tangible property other than real estate, you can take 100% deduction in year one usually. And it's not limited to the profit of the company. So you can even create a loss in year one. And if you're buying a business and spending a lot of capital, it's nice to know that you don't have a tax burden coming your first year. So I think that's a big consideration for the buyer. To take advantage of the depreciation and then the bonus depreciation provision.
Is there anything we should touch on related to amortization? And
can we stay on that stock sale, asset sale real quick, if that's okay? What is the tax difference between an asset sale and a stock sale, like from a seller standpoint?
From a seller standpoint, it's definitely beneficial for a seller to just sell the company and sell the stock. Assuming that the business has been open longer than a year, which is almost always going to be the case, you're granted long-term capital gain treatment on the sale. So you're immediately cutting your tax bill almost in half. So that's an enormous place to start with your tax planning. And then, what else can you do from there holistically to reduce your tax versus an asset sale that's going to be at least partly ordinary income tax rates.
And I'm going to tell you, most businesses that sell for, I don't know, under $10 million, from a broker standpoint, because, this is the great thing, bringing on guests and you're talking to a CPA, somebody that's got a tax expert, your job save people as much taxes as you possibly can. I just kind of want to let sellers out there know that you're thinking about selling your business. Most of the time, it is going to be an asset sale. Because the seller is not going to want to inherit that known or unknown liabilities unless there's a reason why you have to do a stock sale, like you're trying to get those contracts with the company and you can't transfer them over another way. So it's always going to be kind of defaulted as, and I know you don't want to hear this, because you're trying to save people taxes, but from a realistic broker standpoint, sellers can expect usually for it to be a stock sale. I mean, an asset sale, not a stock sale.
No, and the taxes can't drive the horse. I mean,
Yeah.
the horse drives the wagon. So
Yeah.
we have to come behind what makes sense for the business seller and do the best we can from there.
Now, we can also, because this can be thrown out there too, from a buyer's perspective, a buyer would prefer to do an asset sale, but a buyer could propose doing a stock sale and treating it as an asset sale when it comes to the taxes, correct?
That is true, right? It doesn't generally benefit the seller. It benefits the buyer, but it allows them to acquire the company, but treat the transaction from a tax perspective as an asset purchase. It's section,
Even though it's a stock sale.
right. There's two. Well, it's a stock sale purchase, but it's treated for tax purposes for the buyer as an asset purchase.
Does it
and to
harm the seller? Does it harm the seller at all?
Well, it puts them in the same chair as an asset sale.
Okay, gotcha.
It benefits the seller, and the buyer is still paying, varied tax rates, generally higher.
This is the 338, 336 election?
Section 338, exactly. It's an election, and generally it's not going to change the transaction for the seller.
Fair enough. I think that covers asset versus stock sale. A couple other things that I think are really important. A lot of times when we are involved in a transaction, there is some type of installment sale or seller note or different tranches of the purchase price that are provided to the seller at different times. So, of course, every seller wants to take every chip off the table and get as much cash as they can at close. Rarely does that happen. Usually there's some type of equity rollover. There's some type of money held back. There's an earnout. I want to talk about how that affects taxes. So an installment sale is where a seller gets paid over a period of time, right? What is the tax impact on that?
Right. So I think this is one of the most important planning tools there is, because, we talked about the purchase price allocation. That's one of the most important components of the agreement. The next one in line possibly is the timing of the payments, because in the eyes of the IRS, you're going to pay taxes generally when you receive the money. So there's a lot of different ways that you can benefit from this. And one is, if it's sort of common sense. If you stack a lot of income in 1 year, you're going to pay more tax at the highest rate. If you spread it out, you're not only going to delay the payment of some of your taxes, you might pay more taxes at a lower rate. So obviously the nature of the transaction, your comfort with the buyer is very important. But I think that's a tremendous tool. And, veering into your lane a little bit, if you get a good interest rate on the note, a lot of times there's no harm in holding some paper and having a little tax benefit.
And Jim and I debate this on almost every one of the episodes because, I don't encourage sellers to tell their buyer to use a seller's note. I'm never going to tell them to do it. But in the cases that a seller or a buyer is hell-bent on having some type of seller note, because it is an insurance policy to them, that's a good rebuttal, is saying, well, you will kick the can on paying tax on that tranche of revenue coming in. So especially when it's a structured note with interest over a period of time, not tied to the performance of the business, it can be really advantageous to a seller.
I'll still stick with collect all your money on the day of closing.
Absolutely.
And screw the tax savings.
I'll never disagree with that point. So this is a really interesting topic, and it's one that I don't think I've fully wrapped my head around, and it's depreciation recapture. So depreciation is probably the best tax tool you could possibly have, right? You buy a bunch of assets, you depreciate the assets. It's a wonderful write-off. But there is depreciation recapture. Can you talk a little bit about what that is?
I can, but I'm going to point you back to the purchase price allocation, because the recapture is only going to be triggered when you allocate purchase price to assets that were depreciated, right?
Okay.
So really, the recapture aspect, what it says is, if you've depreciated tangible property, when you get rid of or dispose of that property, you're going to recapture the tax savings at ordinary tax rates. I don't know if I said that clearly or not, but basically, if we allocate part of the purchase price to depreciated assets, that's all ordinary income to the seller of the business. So it really goes back to being dependent on the purchase price allocation. There is no recapture if we don't allocate purchase price to the depreciated assets.
Okay. So if you do recapture of depreciation, because the assets are depreciated so much, and you do the recapture, the buyer, that difference between what has already been depreciated and what you're recapturing, you'd be paying ordinary income
Correct.
tax on that, which the ordinary income tax is what you don't want to be paying.
Exactly.
Right? But in this case,
So let's just put figures to it, right? You bought equipment for $400,000 and it's been fully depreciated.
now you're going to sell for, let's say, 100.
Now you're going to allocate 100 or 200 to the equipment in the sale. Whatever dollar amount is the delta is what you are charged ordinary income tax on.
Yep.
If you had $400,000 of equipment, it's fully depreciated. You sell it for 100, you owe the tax on the 100.
Got it.
Yep.
And it's
an ordinary
gonna
income tax.
And it's going to be at, let's assume, the highest rate, 37, not 20.
Yeah. And I have a note here. You cannot arbitrarily undervalue equipment to dodge recapture. Allocations must be fair market value.
That is true.
Do you see that people trying to do that pretty often?
Well, I think it's a complex conversation because it's used equipment. What it's worth to one person, it's not worth to another person. You can use an appraisal, and you also have other assets that you're simultaneously valuing. So I think there's a lot of room there for, I don't want to say interpretation, but analytical review sort of what this asset is worth versus this one. But you're right, that overarching principle applies.
Okay.
And Rich, is it true too in a tax situation, or does it affect it all? Like assets in place might be worth more than if the assets were not in place. Let's take a restaurant, for example. Not that I sell restaurants very many, but like a restaurant, the ovens, the stoves, the hood system, all the stuff in there is probably worth more because it's in place.
Right.
It's already hooked up to the electricity. It's already hooked up to the water, more so than if you were just selling the assets off as an individual piece. Would that be true in a tax situation?
I think that's true. If the equipment is sitting in a used equipment store, its value is not the same as in an operating business. I think that's a fair statement.
Okay.
We talk about depreciation, and we've heard the term EBITDA a lot, and earnings before interest, taxes, depreciation, amortization. These are the typical items that are added back, if you will, for valuation and taxation purposes. I just want to touch on amortization a little bit. I think it's a topic that people struggle with a little bit, but amortization is essentially the depreciation of intangible assets.
That is correct. I think the word amortize means to kill. So you're
Does it really?
I didn't know that.
I think
didn't
it does.
know that.
I'm on camera saying this, so if I'm wrong,
That's okay.
it's documented. But
Somebody
I believe
comment
it means
on
We're going to
that.
go out and
kill.
we're going to amortize some animals in the woods. I don't know how well that would fly.
So how would that fit? Amortize means kill. So like
I
what's
think
that?
I think it means to kill or sort of burn off the value. And it's the same thing as depreciation. It's just applied to a different asset, intangibles. And it's a different section of the Internal Revenue Code. It's a different principle for deducting intangibles. It's a straight line method, for example, versus 168K. That's the bonus depreciation.
Right. So if you, and amortization is mostly tied towards goodwill. Is that right?
Right. It could be covenant not to compete. It could be a customer
Could be a
list if it was
franchise agreement.
segregated. Mhm.
So any of the asset classes in an allocation that are not fixed hard assets, tangible assets, if you are going to amortize them, it is the intangibles. It is the goodwill.
Something you can't touch and feel.
Is there any recapture of amortization?
It's the same principle
Good
as
question.
depreciation.
I genuinely
Good
don't
question.
know the
I
answer.
don't know
to
that either.
Yeah, the answer is the same, and it follows the purchase price allocation. So if you sell goodwill, that's going to create tax at a capital gain rate. There's gain to the extent that you're being paid for the intangibles on the asset, the purchase price allocation.
Got it.
So
let's dive into a sexy topic that we've talked about quite a bit, Rich, you and I, on some of our coastal conversations, but the 1031 exchange. So a 1031 exchange now only applies to real estate. There was a time where it did apply to the sale of a business, right? So what is a 1031 exchange? And I guess we'll give a scenario of where one can be used in a business sale only at a time that it includes real estate.
I think it's such a cliche to tell people, your best planning is done up front. Post-mortem, we have things we can do, but this is where Carey and I geek out quite a lot. We brainstorm and bounce things off of each other all the time. And then it really benefits our mutual clients. And you're talking about an area now where if you don't plan for it, it's not going to work, but it's a tremendous tool to add to the tool bag if it happens to fit the seller's needs. So you're talking about separating off the real estate in a business sale and being able to transfer that, exchange it for other assets and not pay the tax associated with the real estate.
So a $5 million purchase price, which is the number that we've been using.
Say millions.
A million of it is real estate. You can pull that $1 million out and roll that into a 1031 exchange. My understanding—
by buying another piece of real estate.
Correct. But my understanding, and to your part about preparation, is that you can't touch the money when it comes in. You can't take possession of that $1 million for that. It has to go to a custodian, and within 180 days, I think.
Identify in 45 and close the transaction in 180.
And then when you roll it into whatever asset you purchase, you pay zero on tax with it.
Exactly. And hopefully you have another income producing asset, right?
Yep.
And let me say this too out there is, a lot of people that are looking to sell their business and that own their property, they want to retire. They want to sell their property too, because they don't want to deal with the 3 T's: tenants, toilets, and
Termites.
trash. And what'd you say?
Termites.
Maybe there's 4.
Took that from the great
They don't want to
page
deal
of
with
Greg
that. So
Mirbaum.
a 1031 exchange in the traditional sense doesn't seem appealing to them, because then they're going to end up being dealing with tenants, trash, and
Termites.
But there are programs out there. You'd have to go with a financial planner, and maybe you guys, Coastal, that you can invest in warehouse or property spaces, and it doesn't have to be something that you're actually managing. It's more of like I don't know if it's an EFT or what it is.
It's called a TIC, a tenant in common. Is that
tenant in
Or a
common?
Delaware statutory trust.
Where you're
DSTs.
investing in it like you're investing in mutual funds,
Yep.
and you're not, there's maybe thousands of people
Yep.
that are
a
investing.
hands-off investment that provides passive
That
income?
way you get the benefits of the 1031 without having to deal with the 3 T's.
That's a great point. And, we offer institutional style investments. So you have a big company that's done it over and over and over. So you trust them and you believe in them to deliver.
Or Coastal.
Well, I mean, the institutional assets that Rich is talking about, we work with groups across the country that have built billions of square feet of their respective asset class. And some of them are structured to be 1031 exchange opportunities. So you're getting the upside of these institutional assets that typically have return profiles that outperform public markets. So it's always a strategy that we put in front of every one of our clients if it's applicable. But for a business sale, if there is real estate included, that would be one of the tools that we would look at.
Absolutely. Yeah.
I know nothing about this topic, but there is a state tax layer that is involved in business sales, right?
From time to time.
Some states have no income tax. Others have full income tax on the gain. And some states don't even distinguish the difference between capital gains and ordinary income, which is wild to me. Can you talk to anything related to the state tax layer?
Sure. So I think this leads us back to a really important and very basic point. I think it really makes sense for a business seller to have a solid tax projection done somewhere along, in the time frame where you're getting ready to really offer your business for sale. Go ahead and have your CPA prepare a tax projection, and we offer some help with that. And see exactly where you stand. There's going to be some variables that are not completely dialed in. One of the things that will do is ferret out some things like state taxes that maybe you're not thinking of. You're thinking of ordinary tax rates versus capital gain. You're not realizing, there's a 13% tax potentially in California. So if you're in a relatively high tax state, part of our package is we try to look at that as well. And are any of the strategies we're using, are they going to work for state purposes? For example, California and New York don't exactly follow the Internal Revenue Code. So that's another important thing to identify. You're right. Some states have like a franchise tax, and it's not really an income tax. It's based on assets or revenue or something like that. Some don't make distinctions. So I think that's a big reason to have a tax projection done and make sure you identify all your costs up front.
And I want to throw this in there while we're talking about state taxes too. Like every state tax is different. Obviously, we all know that. But like here in Florida, where we're located at, there's no sales tax on the purchase of a business. There is sales tax on the vehicles that are purchased in the business. So if Carey bought my business and I had 5 trucks in the business, and let's say the trucks are worth $25,000 each, when after the sale we go down and transfer those vehicles, he would have to pay, the buyer would have to pay sales tax on the amount that we allocated towards the vehicles. In Florida, that's all there is. In other states, the taxes could be all over the table. Like you might have to pay taxes, the buyer might have to pay taxes, sales tax on all the assets. So, today we're kind of talking about income tax or tax you pay at the time of the you're doing your tax returns, but
way too much
there's
tax.
Other taxes out there too, which the buyer's usually responsible for, but hopefully buyers are listening as well.
So I have a line item in here, retirement planning and lifestyle impact. So sometimes owners forget that they're running their business like a lifestyle business, and they may have a number of things that they live their life daily on, that they put those expenses
Personal
on the business.
expenses?
Yeah.
No, really?
Mm-hmm. And if the business pays a lot of their lifestyle expenses after the sale, those costs hit their wallet, right? So when we're talking about retirement planning, it's not just your 401k, it's not just your IRAs. The business sale is a core retirement asset. So there's as a CEPA, certified exit planning advisor, a critical part of when people are leading up to sale, it's figuring out how much of your wealth is locked up in your current business. Is it 80% of your net worth? Hopefully it's not. But regardless of what it is, those are some of the considerations that need to be taken into play when you're doing your planning. What do you have outside of the value of your business? What items inside your business now that you're currently getting paid for from your business are you going to have to take on? It's all a figure of what do you need to live, right? What dollar amount do you need on an annual basis? Is the money you're getting from the proceeds of your sale enough to satisfy the lifestyle that you want to live? What assets do you have outside of the value of your business that are hopefully compounding over the years? It's a big topic of consideration for every seller when they make the decision, am I going to sell now? Is now the right time? That's a big part of it.
That's huge. Carey, that was you brought up a lot of really good points in a very quick period of time.
Talking a little fast, but
No, it's good points.
So I have here, you need to model expected living expenses, income from the sale proceeds, income from your retirement account, Social Security. Do you use annuities or other income streams? One of the big things, Rich, that we do is at Coastal is when we're sitting down with a client, we find out what is it that you're looking to accomplish. Some people have a thriving business, they're not selling, and they're just looking for capital appreciation and will invest their money into institutional assets. Some are selling their business and then they need another income stream because it's not enough. So we have bond products and we have, products that provide income streams. So all of these are things that as a person considers the sale of their business, it's not just their broker, it's not just their CPA, it's not just their attorney, it's their wealth advisor. It's the person that they're going to talk to after the sale of the business to live their life when they're not generating the income that they were previously from their business. So always encourage business owners to not only think about the tax implications. Another person you need on your team is somebody in retirement and wealth management that understands the effects of taxes.
I think this is a good time too to observe. Like as a CPA, I've had the pleasure of watching people start businesses, add partners, go through difficult times, put their own financial well-being on the line. And to me, when you arrive at the finish line and you have the privilege to go and sell your business to someone else and it's going to live on, that is an enormous accomplishment, completing the cycle. And I'm still amazed by it. And it's what, keeps me on fire for working. And I think you're talking about sort of the personal part of selling your business, that there were all these things probably baked into it and they're coming out now. And you have a lot of decisions to make about, well, do I really need 3 cars? Or, It starts making you question things. It's a good time to think about it when you respread your financials to say, what is this business worth to me? I feel like it's a reckoning with the history of the business, but it's, let's have a moment of observation for people who are completing the cycle. They have the opportunity to sell their business after all their hard work.
It's funny because as a M&A professional and someone who sells businesses for a living, I did sell one of my businesses about a year and a half ago. And I didn't even go through that process myself. I'm literally trained and certified to walk other people through it. The certification happened after the sale of the business. But things like that, multiple cars, the lifestyle business, all those types of things, you know, it was foreshadowing a little bit because I did have those thoughts, but I didn't necessarily act on them. I think it's even the more reason that people should hire professionals to teach them how to do those types of things.
Yeah. You know, I think, you know, and I know this is kind of getting off subject, but, you know, we are kind of talking about timing. And I do want to say this is that, you know, if you're getting close to retirement age and most of your assets are tied up in your business that you own, you really need to give a second thought. I mean, look in the last 25 years, we had September 11th happen. I was talking to Rich before we started the podcast, that I owned a company and I lost it due to September 11th. You know, when the planes went into the building, September 10th, I wouldn't have sold the business. On September 12th, I would have given it away.
Mm-hmm.
Then we had the Great Recession in 2008 to 2010, and then we had the COVID. So in 25 years, we've had 3 major events that greatly affected businesses in this country.
Mm-hmm.
Never know when the next one's going to happen, you know? So I just want people to keep that in mind.
I have people all the time after I give them a value, and 9 out of 10 times, maybe 9.9 times out of 10, it doesn't match the value that they wanted. And they ask me the question, well, should I sell? I am always a proponent of, if you can get the money today, even if it's a little less than your expectations, take the money and move on to your next chapter. And, you know, I've had people that are toying on the edge of like getting over $1 million of EBITDA or 2 million, which is a number that, you know, private equity groups really want to see. You never know what's going to happen the next day.
Yeah.
If you have something that's sellable and you have a buyer ready, willing, and able to buy it at a good price, I really do think they should almost always consider to sell it unless there's extenuating circumstances.
And, you know, and I look at it as, if a person's like 40 years old, yeah, maybe not. But if you're 65, 63, 67, you know, and you're able to sell your business and have a good lifestyle, you may want to think about doing it.
I have a couple other points that I'll throw out as we move towards the end of the episode. Common mistakes that sellers make related to our topic today, and maybe we'll just have some commentary on each one. Probably the most important is waiting too long to think about tax. Reacting reactively instead of proactively as you get close to closing. Oh shit, I thought I was going to get X because that's what's on the contract. I'm going to get Y. It's so easy to prevent that, right?
Couldn't agree more. And I think, you know, there's pre-closing and there's post-closing. And, you know, it's a little bit like an amputation. I mean, once the limb is cut off, you're limited what you can do.
Mm-hmm.
So as a tax guy, we do our best work when we start with the agreement. It's one of the nice things about working with you guys is we're kind of involved from the ground floor, starting with the agreement and minimizing tax there. And then after the closing, it's a more holistic approach to the tax bill, right? So, you know, that would be my tax comment.
I had another item here, making structural moves alone, like distributing real estate out of a C Corp without realizing that the move itself is taxable. You know, people do conversions of their entity structures all the time. People are moving things around and they're doing it just because they think it's the right move. Every one of those moves should be ran by a tax strategist. They really should.
That's about having advisors and everyone communicating.
Yeah.
I just saw a situation where a CPA made an election that shouldn't have been made. And it was because the other advisors that should have been involved were not involved. And so the entity was classified the wrong way.
I think when you're selling a business, you got to talk to your CPA, your broker, and your attorney when you're going to make big moves.
Oh, yeah. I've actually started in my practice when I start engaging with a potential seller, asking them about their team. Who's on your team? Who do you currently have?
Do you need anybody?
And I provide,
a lot of times they need people.
I provide a suggestion every time. I'm surprised how many people don't have counsel, how many people have just a general bookkeeper, maybe use H&R Block to file a tax return or something like that. No offense. Yeah. But, you know, knowing who's on their team from the beginning is a big part for us. In the SEPA framework, identifying your team in the beginning is a critical component, because if you are going to sell someone's business, they should start building those relationships if they don't have them from the beginning. Or if they do have them from the beginning, to your point, it's getting them all rowing in the same direction. It's having the conference call of, hey, I'm planning to do X, Y, and Z. Here's my timetables. You do this, you do this, you do this, and let's get a game plan together versus doing it in a siloed vacuum. Another common mistake, chasing no tax schemes and fancy trust promotions that sound too good to be true. Everything that we look at from tax strategy and coastal has multiple tax opinions from tax attorneys, some of the best in the country. Jim, we typically as M&A advisors, we put our hands up and we say, hey, go talk to your tax professionals because it's not our area of expertise. But you're going to pay tax when you sell your business. It is, how can you not beat the system, but how can you
Minimize
use the codes that are there properly to reduce the tax implications?
Right. And I think the first thing to say is every transaction is different. So the nature of the business, the fact pattern of the owners of the business, those things come in when we're doing that holistic part of the planning. And when I say holistic, I mean on someone's personal tax return, they're reporting the gain from this business and they're reporting all of their other taxable income sources and whatnot. So for example, we do have assets that create tax benefits. One asset might work better for one person than another. And evaluating that, explaining it to the seller, making sure they understand it. Is it a good fit? What's your tolerance for risk? How much risk is there? That's what we do a lot of.
Because it's not boilerplate. And the next point was assuming that a seller knows their tax based on what a friend did or something that they read, right? Every individual's fact pattern is different. What's on their 1120S business tax return or their 1040 personal return is going to be different than for you and for you and for me, even if we're business owners that are business partners in the same business. Everything that we do outside of the business has an impact on tax.
Yeah, over my career, I can't tell you how many thousands of times I've had people come to me and say, my buddy Al told me I could do it this way.
Yeah.
It's okay if it generates conversation, but make sure you're running it by the right people. And, I think what I've learned or has been really emphasized to me since I left public accounting is how important specialization is. Having guys that really understand all the issues involved in selling a business. And then maybe you need 2 CPAs. We're not here to replace your CPA. We're here to magnify and amplify what they can accomplish for you.
Yeah, it's another perspective.
I think that's a good point, is it's not you working directly with the business owner. It's the business owner talking to their CPA and their CPA getting with you and you helping with the taxes. And then you're talking the same game as the CPA.
Exactly. And they'll know that we practice just like they did, but they know the client best. They know the business best. So we're not throwing the baby out with the bathwater. They add a tremendous amount.
Well, you and I did that ourselves for my situation. I sold a business. I called up my CPA who doesn't specialize in business sales or advanced tax strategy. She knows my pattern because she's been my CPA for years. We hopped on a phone call, the 3 of us. She provided you with everything that she knew. You provided her with some new tactics, and together you guys solved a tax problem for me. And it's the perfect example, full circle on how it should be. Now, if you don't have access to those people, it's a different ballgame, right? But for us, Jim, we become a resource beyond just selling someone's business. We provide them and point them in the right directions for people that specialize. Again, to the point, work with specialists.
Yep, totally agree.
I'm a believer there's a best path. And that's what we're looking for, is the best possible outcome within the limitations and legalities and so forth. There's not a perfect outcome, but there's a best outcome. And if we find that, we did our job.
Absolutely.
That's a perfect way to put it.
Yeah. So just some recap and big picture advice. I mean, I think one of the biggest things that we can all agree on is that it's never too early to start the planning process. And as you're inching closer to getting ready to sell, sit down with a specialist, a tax strategist, help them or have them help you understand what your worst case and best case scenario could be, what tactics and strategies you could use. Using specialists, treating it like a heart specialist. You're not going to go to a general practitioner if you have a heart problem, right? You're going to go to a heart specialist. Accept that you will pay some tax. When you sell your business, you're going to pay some tax. But how can you mitigate it best? Don't fall for any schemes. And knowledge is power. I think it's really important that you educate yourself on the different structures of entities, different structures of sales, purchase price allocation. It's all of these things together. It's not one singular item that's going to be the tax implication when you sell your business.
And I think, for business owners out there that might be listening, they might be sitting here going, well, I don't want to spend the extra money on another CPA. I mean, this is more money. But the amount of money you could save in your taxes could make a huge, huge difference. It's an area that it's well worth spending. You're going to make that money and much more back on what you're going to save.
And I think when you've seen a lot of this, it doesn't take long to look at a scenario and decide whether you can really add anything or not.
Yeah.
And if it's a relatively small transaction or there's just not that much there, then the expense is, I think, going to be pretty nominal. If it's complicated, then there's more time to be spent. But
there's more money to save.
Yeah, exactly.
Yeah.
So I think it's pretty easy to take a look at something and decide, can we add value here?
One more point I'll add that is not necessarily on topic, but Rich, you'll appreciate this, and Jim, we've talked about it 100 times. We talked about the lifestyle business and business owners that are running their books like a lifestyle business. I encourage every seller that's listening to this or any business owner to run your books as clean as you possibly can. Think about it this way. Let's assume you run a healthy business, you're a high net worth individual, and you're taxed at like a 37% rate, right? Correct me if I'm wrong, but for every dollar that you write off of an expense that maybe should have been a non-expense,
it's not an expense,
you're going to save 37 cents on that dollar. When you go to sell your business, if you're getting a multiplier of 4, 5x, 6x, 8x, or 3x, even 3x, that $1 that's now on the bottom line, because you paid tax on it, you're getting $3, $4, $5, $6. What's
instead
better,
of saving
37 cents or $4, $5, $6?
Yeah.
Right.
And it makes, again, you can win once. You can win at the end when you sell your business, or you can win every year when you pay a little less in tax. Choice is yours.
Yeah, I think that's perfectly said, because there's always a yin and a yang to a lot of these strategies, and what looks good on your books for the bank doesn't look as good on your tax return, right? There's that scenario is something we always wrestle with. And I think it's a balancing act.
Absolutely. And we could talk about this for a very long time, but we wanted to cover the surface level stuff about the tax implications of selling your business. Rich, really appreciate you jumping on with us.
My pleasure, guys.
Again, we appreciate all the viewership and listeners that tune into our episodes of Boss Talk, Selling Businesses with Jim Parker and Carey Sobel. We appreciate you listening in, and we look forward to seeing you on the next episode.